Hello and welcome to another tutorial video. This one is going to be about deferred taxes, as you can see on screen, a topic which comes up in almost every company's financial statements, but which also tends to be overlooked in tutorials about financial modeling and valuation. So this one comes directly from a question that came in the other day from one of our students. Can I ask what is the usual sign convention for linking deferred taxes on the cash flow statement? I'm not sure if deferred taxes should always be linked with a plus sign or a minus sign, or what the different signs mean. Can you explain? So I'm going to give you a short answer on this and a recommendation on how to treat these in models, but I think we need to start by explaining exactly what deferred taxes are, because a lot of people don't really get that concept, and if you don't know what they mean and what they refer to, the projection methods are not going to make sense. On the income statement, when a company records revenue or expenses, it doesn't necessarily mean that the company has earned the revenue in cash or paid the expenses in cash right away. And this is because items on the income statement are based on delivery, not cash payment. So if a company has delivered a product to a customer, it can record that as revenue. And if a company has ordered something else from another company and received it, it can list that as an expense, even if it hasn't paid for that expense in cash yet. A company could pay first and get the product or service later, or it could get the product or service first and then pay for it later. And if you're familiar with items like accounts receivable, you know how this works. If a company has $1,000 in revenue and then accounts receivable goes up by 100, let's say, yes, the company records an additional 100 in revenue on the income statement, and so its net income increases. But from a cash flow perspective, the company's cash flow is actually worse now because it hasn't actually earned that revenue in cash from the customer. It's delivered the product to the customer has it, the customer has not submitted cash payment. And so the cash flow is actually worse because we have to deduct this 100 that they have not yet received. The same is also true of income taxes on the income statement. They do not necessarily represent the amount the company pays in cash to the government in that period. And so this deferred tax line item represents the adjustment between taxes on the income statement, also called book taxes, and then the cash taxes that the company pays to the government. So for example, let's say a company records a negative 100 in income taxes on the income statement, meaning that according to its income statement, it pays the government 100 in taxes in this period. On the cash flow statement, if the deferred taxes are a positive 30, what it means is that the company's cash taxes are actually negative 70 here. So in other words, they only pay the government $70 in cash, not the $100 in cash that the income statement would suggest. And then likewise, if the deferred taxes are negative 50 on the cash flow statement, then the company's cash taxes are this 100 plus the 50 here for a total of a 150 cash outflow. So they're actually paying more in cash taxes than their income statement would suggest. Now, the reasons why vary, and we'll cover those in the next sections of this tutorial, but I want to keep going here and give you a few simple rules to describe how to deal with the situation in models. So the short answer here is that the easiest method is to review the company's historical deferred taxes and continue the trend using simple percentage assumptions. Now, if the company has recorded significant operating losses in previous years, and therefore has a large net operating loss balance, it is worth creating a schedule to track that if you have the time to do so. You can take a look at our tutorials on Uber and Snap and Atlassian in the growth equity case study, and also the one on net operating losses in a DCF in this channel. I'll link to all these below the video, and I'll also include a card to some of these videos here. The bottom line is that what you generally want to do in these cases, I'll bring up an example for Steel Dynamics here, is to look at something like the deferred income taxes on the cash flow statement. You want to look at these as a percent of the income statement taxes as we're doing here. And you can see that historically, if we just take an average, they've been somewhere around the 25% to 30% range historically. So the company's cash taxes are less than its book taxes, and then we just continue this going forward. We make the percentage decrease somewhat over time, but that is the basic idea and the quick and dirty method for dealing with deferred income taxes. It's not about determining the correct sign. It's about picking what the company has already done on its cash flow statement, and then assuming the trends continue, you just continue that going forward, and you keep making deferred income taxes positive or negative, and using a percentage that is in about the same range as it was historically. So the outline for this tutorial I'll put on screen right now, and as usual, I will put the timestamps on the side as well so you can skip around. In part 1, we're going to cover net operating losses and how they affect deferred taxes. In part 2, we will talk about accelerated depreciation and how they affect deferred taxes. Then in part 3, we will go through stock-based compensation and a couple of other items like asset impairments and write-downs and how they affect deferred taxes. And then in part 4, I will go through a summary of the model and valuation treatment that sort of just sums up everything we've been through here and gives you a recommendation for what to do based on the amount of time you have and the type of company you are analyzing or valuing. Let's go to part 1 with NOLs and deferred taxes. Now, I want to start by saying we've covered this topic many times before in various examples in this channel. So take a look at the videos on the Uber valuation, the Snap valuation, the Atlassian one in the growth equity case study. Take a look at the one on NOLs and the DCF. All of it's there and none of it is really different. So I'm going to go through this fairly quickly here. The basic idea is that if a company records negative pre-tax income, it should still list income taxes based on its tax rate times the pre-tax income. So let's look at an example of this in the accompanying Excel file here. I'll go to the NOLs tab. You can see here the company has negative 100 in pre-tax income in year 1. And so it lists income taxes based on this negative 100 times the 25% tax rate. It looks like they actually get a tax refund because the income taxes are not negative on the income statement. They're actually positive. But in reality, what happens in this case is that the company actually pays 0 in cash taxes or close to it. It doesn't get a tax refund from the government. It just accumulates this loss that it can use in future periods. On the cash flow statement, there will be a negative for the deferred taxes in this case, so that cash taxes equal about 0. And if you go back to this Excel example, you can see how it works. Since the NOL adjusted pre-tax income here is negative 100, that's a negative, which means the company doesn't owe any cash taxes. And what this means is that the deferred taxes here are negative because an NOL is being created. If we add these up, the income taxes and then the deferred taxes to get to the company's cash taxes, you can see it's just 0 in this case when the company has this negative pre-tax income. So that is the basic idea for how this works. NOLs get created when the pre-tax income is negative. They get used up when the pre-tax income turns positive. Deferred taxes on the cash flow statement are negative when the pre-tax income is negative, and when these NOLs get used up, the deferred taxes flip and turn positive because now the company is applying the NOLs to reduce its tax burden. So as I was just saying, when the company's pre-tax income turns positive, it can use these NOLs to reduce its cash taxes. So maybe the company will list negative 100 in taxes on its income statement, but in reality, it might only pay 50 or 25 or 0 in cash taxes until the NOLs run out. So you can see an example right here where they now get 200 in positive pre-tax income. They list negative 50 for the income taxes, but because of the fact that they have this $200 NOL balance, they can reduce their taxable income to 0. And so they owe no cash taxes here. And so on the cash flow statement, we put in this positive 50 for deferred taxes. And the company, if you add up both of these, ends up paying 0 in cash taxes because it offset its positive pre-tax income with losses from a previous period. And then if we go beyond that to year 3, the cash taxes here are now the negative 75. They match the book taxes. And so there is nothing for deferred taxes here because now the company has used up its entire NOL balance. It has positive pre-tax income. And so everything is normal and nothing is built up or used in this case. Now, the model treatment here really depends on the size of the NOL balance and how long the losses are expected to continue. If the company has a huge balance, and there's a good chance these losses will continue because it's an unprofitable tech startup or tech company, for example, you should probably build a schedule. We have an example of this in our Uber valuation where we create NOLs and then we use them up here. And then we just calculate the cash taxes directly based on the NOL adjusted operating income here. So we don't even factor in deferred taxes because of the way we set up the schedule, but we create the NOLs and then we use them up over time as the company eventually turns profitable in future years. So you should probably do that if you're dealing with a company like this and you have the time. If the company's NOL balance is very small or not significant, or they're not expected to realize these types of losses in future years, I would just simplify it, maybe assume slightly lower numbers for cash taxes. So maybe you can go in and you can say that the deferred taxes will be slightly positive for a few years to reflect the lower cash taxes, but you can keep it very simple and you don't have to go beyond that. So this is the first scenario in which deferred taxes often come up in models. Let's go to the second one and talk about accelerated depreciation. The idea here is that if certain assets are more useful in their earlier years, a company can accelerate depreciation for tax purposes. So let's say a company spends $100 on CapEx, and then it expects the assets to last for about 10 years. There's no salvage value, they're worth zero at the end. So it records 100 divided by 10 for $10 per year in depreciation on the income statement. Let's go to Excel to take a look at this. So the Excel _ depreciation or DEPR tab here, you can see it right here under book accounting. They've spent $100 on this initial CapEx. They're depreciating 10% of it per year. And so on the income statement, they record 10 in depreciation. And that is how it works if you're just looking at the company's financial statements as disclosed in their public filings, for example. For tax purposes, though, the company might be able to record something like $25 in depreciation in year one and $20 in year two. And maybe eventually they get to the point where in the last few years, they're only recording $5 per year, which is less than the book depreciation here. And the reason this happens is because, again, they will try to claim that a certain asset might be more useful in earlier years, and so it should be depreciated more quickly in year one, year two, year three, and so on, than it should be in year 8 or year 9 or year 10. The end result of this is that the deferred taxes in earlier years will be positive because the company's cash taxes are less than its book taxes. Again, let's take a look at this in Excel. You can see the tax version here where we depreciate 25%, 20%, and 15% in years 1 through 3. And then if you go down and look at this, the operating income is lower, pre-tax income is lower, and the income taxes are also lower on the tax version of this company's financial statements. And since the cash taxes here are less negative than the book taxes, we get deferred taxes in each year. And so if we look at this company's cash flow statement, we would see this entry for positive deferred taxes here, meaning that because of this accelerated depreciation, this company, at least for these years, is going to pay less in cash taxes than it will in book taxes. And so it gets a cash flow benefit from this arrangement. Now, the problem with this is that most companies in real life do not actually disclose all the details of their depreciation policies. They might tell you if something is straight line or accelerated, but they're not going to break it down and tell you exactly what they're doing for tax purposes. So if you have a company like this with consistently positive deferred taxes because of accelerated depreciation, it's usually best to simplify and use a simple percentage estimate. For example, with Steel Dynamics, the example I just showed you before, it's a steel manufacturing company, it's in a mature industry, and they've had consistently positive deferred taxes. So here we have no real idea what their actual depreciation policies are, but we can say that since their deferred income taxes are pretty much always positive going back 5 or 10 years, it's a good bet that this company is paying less in cash taxes and it will continue to pay less going forward into the future because it also keeps spending money on assets, on CapEx, and it keeps depreciating them. Now, we think that the effect size will be smaller, that it's probably going to go down to more like a 10% differential by the end, but that is a very quick and simple way to do it when you're dealing with more of a mature manufacturing company like this that is using accelerated depreciation. That's part 2. Let's now go to part 3 and talk about something else that affects deferred taxes, which is stock-based compensation. Companies can pay their employees in cash, in salaries and bonuses. They can pay in benefits, and they can also offer them stock-based compensation. So they can give them shares in the company or stock options or RSUs, restricted stock units. But when a company first grants stock to employees, it is not immediately deductible for cash tax purposes. Usually, stock-based compensation only becomes deductible when the employee exercises their options or when the employee finally sells their shares. The timing of this is impossible to predict, but the justification is that since this is a 2-step process, in other words, the stock options are granted and then they must be exercised later on, tax authorities do not think it's justifiable for the company to immediately be able to deduct this and reduce its taxes, especially because by the time the options are exercised, the value of the company's stock might have changed. The same issue also comes up with items like asset write-downs and impairments as well. With these types of items, asset impairments and write-downs, they also become deductible only when the loss or write-down is realized via a sale of the written down asset. So if a company says that an asset is worth $100 less and records a write-down, that's all well and good, but they can't actually get a tax benefit from it until they sell the asset at that lower value, proving that it is, in fact, lower. If a company has significant stock-based compensation, like many tech and biotech firms do, or it has many impairments or write-downs, its cash taxes are often higher than its book taxes because these types of items are not immediately tax deductible. The result is that deferred taxes on the cash flow statement will have a negative sign. Let's go into Excel and take a look at an example of this. I'll go to the SBC tab over here. So here we have the income statement from a book accounting perspective, where we have the cash operating expenses and then we have the stock-based compensation paid to employees. In this version, everything looks standard. We have the operating income, we have net income, we have income taxes. But then on the tax version, we can deduct things like employee salaries and bonuses and other expenses of running the company that are paid in cash. But for something like stock-based compensation, it's not an allowed deduction, at least not right away on this version of the income statement. And so what ends up happening is that the operating income is about $100 higher. And so the income taxes on this version are 25 higher, meaning 25 more negative in each period. As a result, the deferred taxes here are actually negative over time. Because of this difference, because the company is paying employees with the stock and it's not immediately deductible, we get a negative for the deferred taxes here. And on the cash flow statement, this would also appear as a negative. This deferred tax asset builds up over time, and eventually, if employees exercise their options or finally get their shares, the company can now claim those as tax benefits, and this will go down, and then the deferred taxes will eventually turn positive on the cash flow statement. The issue is that the timing of this is very uncertain, and so in most models, you will also tend to simplify the scenario and just make deferred taxes a percent of book taxes, or you could link them to the tax rate times the non-deductible expenses if you have that information. For example, in a valuation of this biotech company, Jazz Pharmaceuticals, here the company has two non-deductible expenses: the amortization of intangibles from acquired companies and assets, and then a relatively high stock-based compensation expense. And so what we do here is we just look at all these together, we multiply by the tax rate, and then we go down and we use that for our deferred income taxes in this model. We just say, we don't know exactly what they're going to be, but we know the company has these two rather large expenses that are not actually going to save it anything in cash taxes. And so we need to reduce the company's free cash flow by the amount that they are not, in fact, saving in income taxes right here. So that's an example of how you do it in this type of context. So let's go to part 4 now and talk about an overall summary of these rules and what to do in valuations and models. The first step here is that you need to assess why the company's deferred taxes might be positive or negative, and you also need to think about how much time you have. Is this something that needs to be done in 30 minutes or 2 hours, or do you have 2 days or a week or several weeks to do it? If you have very little time, such as 3 hours, 30 minutes, 1 hour, something in that range, I would just simplify all this and I would make deferred taxes a percent of the company's book taxes and continue whatever historical trend you find. There's a good example of this, again, in the Steel Dynamics unlevered free cash flow projection here. It's clearly positive, and clearly the company is paying less in cash taxes than it is in book taxes, and so we just continue that going into the future. This is a short 3-hour case study, so we don't really have time to get too complicated here. If you have more time, such as several days or a week, and the company has a significant NOL balance, it is worthwhile to build a simple schedule. It's not really going to take that much extra time. You can look at some of our examples. I like the Uber example here because it shows you how to apply this in the context of a DCF. But essentially, when you have a schedule like this, you can often just skip deferred taxes and go straight to the cash tax calculation if you're going to set up an NOL schedule like this. So this is an option if you do have more time and NOLs are more significant for the company. And then the third option is if you have more time, such as a few days or a week, and the company doesn't have significant NOLs, again, I would just simplify and use simple percentage estimates, maybe factoring in specific non-deductible expenses like the stock-based compensation if you have that. But even in this scenario where you have more time, I don't really think it's worth scrutinizing this in too much detail and going back and forth on what to do. It's a fairly simple line item. And the main point of all of this is that if a company's cash taxes are greater than or less than its book taxes on a consistent basis, then you do want to reflect that in 3-statement models and also in valuations when you're using a DCF to assess a company like we are in these examples. So let's do a quick recap and summary now that we've reached the end. So we started out by explaining the basic idea behind deferred taxes and how, just like items such as accounts receivable on the balance sheet let us represent the timing difference for recording revenue and then receiving it in cash, deferred tax assets and liabilities let us do the same thing with the income taxes. The first scenario we went over here was net operating losses and deferred taxes. And with this one, the main point is that unlike some of these other items, net operating losses could go either way. If a company experiences a loss, the deferred taxes will often be negative to reflect the fact that it pays nothing in cash taxes. But then in future periods, when it applies those losses, the deferred taxes flip and become positive to reflect the tax savings from those losses. Then in part 2, we walk through accelerated depreciation and deferred taxes. This is a bit more of a straightforward scenario. When you have a company like this, generally speaking, the deferred taxes are always going to be positive by at least some modest amount going forward because they're going to keep spending money on CapEx, they're going to keep depreciating assets, and if they accelerate it, the tax version of depreciation is always going to be higher than the book version, and that means the cash taxes are going to be lower than the book taxes. Then in part 3, we talked about stock-based compensation and deferred taxes. This is also straightforward. If a company is paying a lot in stock-based compensation to its employees, deferred taxes are usually going to be negative, assuming there are no other major line items because they're not immediately tax deductible. And so you have to reflect that in any type of projection or valuation of the company. And then in part 4, we went through some simple rules for model and valuation treatments. I prefer to keep it simple, as I've been showing you in this Steel Dynamics example. But if you have more time, as in the Uber example, you can certainly build in a model for something like NOLs. I wouldn't recommend building in a schedule for something like accelerated depreciation or stock-based compensation. I would just keep it very simple and maybe use 1, 2, or 3 lines in the model to estimate the deferred taxes in those cases. That's it for this tutorial. Hopefully now you know a little bit more about this topic and you understand more about how to approach this if you have a case study or a modeling test, or you're just trying to build a 3-statement model for a company or value it.